We will now consider entrepreneurial risk management. The very nature of the entrepreneur is to have an instinct, a gut feel for likely impending changes by being very close to the market. For example, will the market for crude oil change next week? If so, will it be a minor change or a major change? And will this change be upwards or downwards? And is it worth investing into or not? And is it worth investing large or small sums of money? And also, is it worth advising others? So, high-risk strategies or low-risk strategies have to be considered and deployed. The very fact that risk is involved is extremely appealing to the financial entrepreneur, and so they very often also consider international opportunities to expand the potential gain that they can make. So initially we need to consider one, foreign exchange markets, as the currencies being traded tend to fluctuate during the day, every day of the 5-day week. So profit can be made on the margin on a continuous ongoing basis, providing the entrepreneurial instinct for change remains intact. This is simply based upon the calculation of the amount of one currency needed to purchase one unit of another currency. Another opportunity within foreign exchange markets is to make profit through the use of the spot rate of exchange, which is the exchange rate for an immediate transaction. Again, there are fluctuations, usually on a daily basis. This means that a value can either appreciate or depreciate. Again, the entrepreneur is looking to capitalise on the opportunity. For example, this method has been used to buy crude oil on the open market. And then 3, the forward exchange rate. This provides another opportunity for the entrepreneur to make money. This involves the exchange rate for a forward transaction. How it works is that an exchange rate is agreed today. However, the delivery of the agreed currency will occur at some time in the future. This might be in 1 month's time, or 3 months' time, or 6 months' time. Profit is expected to occur based upon an expectation of the value of the currency appreciating in the interim period. Obviously, any expected inflation rates will have to be built in to the calculation and transaction. Other considerations will be the cost of living in different countries and the theory that the price of goods in all countries should be equal. The publication The Economist amusingly uses the price of purchasing a McDonald's Big Mac burger, a hamburger, in each of the countries of the world in which these hamburgers are sold. It uses this as a guideline to the cost of living in each of these countries. The price of purchasing a Big Mac in Switzerland is twice as expensive as buying one in the USA, and it's 4 times as expensive as buying one in China. Obviously, with the economy of China on the march, together with the economies of India, Brazil and Russia, this comparison will change over time. Many entrepreneurs look to borrow the money to make their purchases, be it the foreign exchange markets or the spot rates of exchange or the forward exchange rates. So they clearly need to consider the current cost of capital, as when they borrow they have to pay back interest in the future. So their speculative financial investment must accrue a sufficient gain to allow them to pay back the loan plus interest and allow them to also make a profit. Many individuals or organisations do look to protect themselves as best they can against currency fluctuations that are likely to occur. So to reduce risk or avoid risk altogether is referred to as hedging. An example of this is this. The British company Enterprise Oil, who bought oil properties from Texas Eastern for $440 million, paid this amount delayed. 2 months later it was paid. So what they did in the meantime, they borrowed sterling and converted that money into US dollars at the current spot rate. These monies were then invested for 2 months, so when payment was due 2 months later, the company had enough money available to pay in dollars. However, if in the meantime the US dollar had depreciated, then it would have had to find more money to conclude the deal. Again, in stocks and shares, there can be a call option, where the holder has a right to purchase the stock or asset at a fixed or specified exercise price either on or before the exercise date. And there is a put option, where the holder has a right to sell the stock or asset at a fixed or specified exchange price either before or on the exercise date. Again, this may be a high-risk strategy for the entrepreneur. However, they may profit greatly, particularly in highly volatile markets. Some entrepreneurs will hold both a call option and the put option at the same time, and this is called a straddle strategy. The futures markets. A futures contract is an exchange traded. It's a promise to buy or sell an asset in the future at a pre-specified price. This is different from an option where the holder has a choice of whether to deliver or not. A futures contract is a firm promise to deliver and at a fixed price. An example of this could be wheat after the end of the wheat harvest, or it could be the cocoa bean. Here there does tend to be a great deal of hedging activity within the futures market. This is due to the fact that crops are subject to the weather and the quality and quantity or yield cannot be guaranteed in advance. If, for example, there is a glut or surplus of a product, the bottom might drop out of the market and the product might have to be sold off at a very low price. Other examples of this include sugar, the soya bean, pork bellies in the United States, orange juice, crude oil I mentioned earlier, and copper. They tend to be referred to as commodities. So there is a risk in relation to the future and in relation to the perceived or expected supply levels and their apparent match or mismatch against the quantity that will be demanded when that future actually arrives. This does allow tremendous opportunity for financial gain. However, there is of course the risk of miscalculation leading to financial losses instead. So hedging against futures markets is a must for many financial entrepreneurs. This is because they may feel they need some degree of protection in relation to their prediction. Other forms of protection include swaps, which are arrangements usually by two parties to exchange one stream of cash flows for another, and in particular currency swaps, which are arrangements by a company or individual operating in more than one country or more than one market, more than one economy at the same time. They may, for example, be operating in both the USA and Germany. They may recognise that in the current economic climate that more attractive terms for a loan can be obtained in the US using US dollars rather than in Germany using the euro. So a loan of, for example, $10 million at 5% over 5 years is arranged. Then the future liability in dollars is traded into euros. How this works is the bank being used agrees to pay sufficient amounts of dollars to service the loan. In return, the organisation or individual agrees to make a series of payments, possibly per annum in euros, into the bank from profits of its business activities that are actually based in Germany. It may well be that at the end of the 5 years, the 5% loan becomes the equivalent of a 6% loan instead, due to the differences in the values of the two currencies over the set period of time. So, we have talked about reducing risk. However, if an entrepreneur has a complete confidence in a financial opportunity, then he or she may decide not to hedge in their efforts to enjoy a maximum financial return. This is called speculating. Unless you believe that the odds are stacked in your favour, speculation would be extremely foolish. You would need to believe that you are better informed than the highly paid executives working in the leading banks and financial advisory companies to even contemplate doing this. These commodity markets are also referred to as derivatives. And on occasion, someone who has specialised in a particular derivative comes to understand the market in intricate detail. For example, in Japan, a person called Mr. Copper, and in the USA, a man called George Soros with platinum. However, detailed knowledge does need to be matched by timing, when to enter the market and also when to leave the market. Mr. Copper left it too late to leave the market, and eventually his losses were calculated at approximately $1 billion US. Other speculators, such as Nick Leeson at Barings Bank, have also come unstuck. His losses were estimated to be $1.4 billion US. So, good financial management does also need good risk management as well. So this is likely to mean the introduction of some form of hedging activity in the majority of cases. So we have considered the following: cash, stocks, bonds and commodities during this presentation. In the next in this series on financial management and investment, we will explore the areas of risk management, financial entrepreneurism and hedge funds in greater depth. Thank you.